Yeah, I just think there was the language around going into restrictive territory. Following Powell's words about a week or two ago, it just firmed up the feeling about what we already knew from the dot plot, but just firming up these surroundings about sort of a determination around the rate hike and about future rate path and a willingness to kind of take it into restrictive territory.
So when they say they're willing to go through and take it to restrictive territory beyond the neutral rate, what is that terminal rate, do you think? Are we looking at 3, 3.25, 3.5? Is that where you see them ending up in this cycle?
Well, I guess, yeah, I mean, that's obviously the terminal rate as per their forecast at the moment around the 3.4 mark. So I guess you could say, you know, if they're going to go, around the 3.1 mark, rates to go to the 3.4 mark. So yeah, 3.25, so it wouldn't be a bad sort of view in terms of where the Fed see things going.
But again, looking at the language, they say that they want to avoid an overshoot in inflation. We're not really seeing it. CPI is averaging about 2%. Core CPI is very close to that number as well. We're not seeing hints of inflation getting out of control. Are they just perhaps being a little bit too trigger happy?
Yeah, I think that's definitely where we come from in terms of our analysis of it. We think, you know, the Fed will ultimately push the US into recession by following this path. And yeah, these sort of
think they're going to
and within the next couple of years, yeah. And so we're very much of the view that and you know, we look at the trigger effectively of the flattening of the yield curve, even though when you adjust for what's happened with QE, that's our trigger signal.
Yes, but crucially, if you look at the yield curve, we've actually re-steepened back in the last month or so. 2s10s is back. At one point, we got to 20 basis points. Now we're up at 30. And it is telling you that this recent sell-off has actually been led by the intermediate belly part of the curve rather than the front end of the curve. Yeah,
I think for us, you know, we think there are a few factors that led to that the steepening of the curve, and we see that flattening back. So that's builds into our view, really. We see it sort of a term premium-led move that's more an uncertainty move than it was any certainty about higher growth and inflation.
And do you think that the Fed will continue hiking even if they think that it's going to end up inverting the yield curve then?
I think they will hike to the point where we think they'll hike until they've basically hit the point of no return. So that, in our view, that's a couple of rate hikes. And other people's it's slightly more, but we think they'll kind of overhike, and then that leads to the next recession.
What have you been advising clients to do then to express that view?
I guess we really like flattening. So 2s10s flattening is our kind of fundamental theme. We've had it for a long time. That's a view we really like. So that, yeah, 2s10s flattening in the US is kind of a key view.
Do you not think that, I mean, we just had the record budget numbers come out of the US as well. We're north of $700 billion worth of deficit, which obviously has put a lot of strain on treasury issuance, budget issuance, and it's going to continue for the foreseeable future. Does that not get factored into your assessment of where interest rates should end up as well?
It does, but we kind of see the macro story as usurping the story about the increased supply. So it's a demand story, and that more than accounts for what's going on the supply side.